Imagine this scenario. You've worked 2, maybe even 3 jobs. You filed your taxes, you paid the government what they demanded from your income, and now you need to fulfill an obligation that, for you, supersedes everything else. You need to send $500 home to your mother in El Salvador so she can buy vital medicine. So you go through the standard channels, maybe a bank wire, perhaps an app like Wise, or transfer service like Western Union. But starting this year, you get hit with a small surprise. An extra 1% taken directly by the U.S. government right off the top.
$5, I mean, it sounds so small when you frame it that way. $5 on $500, $20 on $2,000. It's almost negligible when you look at the total transaction, and it's certainly nothing when compared to the national debt. And that seemingly insignificant percentage is exactly the psychological trap policymakers were banking on when this measure was rolled out. The idea was to implement a new revenue stream that was, large in aggregate, but small enough per transaction to avoid a huge political outcry.
We are talking about the new reality that hit approximately 10 million American households starting on January 1st, 2026. The implementation of a mandatory 1% tax on all international money transfers, a tax primarily aimed at, but definitely not limited to, remittances. This is a crucial moment because our source material this week doesn't treat this as just another budget line item.
No, not at all. They frame it as a critical economic signal, a signal of profound government anxiety. They argue this 1% tax is the first identifiable step on a very, very dangerous historical path, the implementation of what they call a soft capital control. And here is the core, the really provocative thesis we extracted from the analysis. This small tax is actually going to accelerate dollar decay and an underlying economic crisis, rather than preventing the economic problems it claims to solve.
That's a bold claim, because a 1% tax just sounds like minor policy tweaking. Okay, let's unpack this. If we look beyond the official rhetoric, what does this small 1% tax truly signify for working families here? And, maybe more importantly, for the fundamental future of the US dollar and its role globally. We're diving into the mechanics of the deduction, the dubious justifications used to sell it to the public, and the 4 terrifying historical failures this tax is echoing right now.
To start, we really have to look at the cold, hard mechanics of how this tax functions, because, like we mentioned, the subtlety of the implementation is absolutely key to its political survival. Prior to January 1st, 2026, when you, the sender, moved money internationally, you paid a service fee. This could be a floating percentage, say 2 or 3%, or a flat rate, and that went to the company facilitating the transfer to your bank, or services like MoneyGram, Wise, or Western Union. That fee covered the cost of service, exchange rate conversion, and their infrastructure.
Right, that friction is intentional, but it was historically tied to a service being rendered. What changed is that now, on top of that existing fee structure, the US government takes a flat 1%. And it's assessed on the gross amount you send, regardless of the exchange rate or the final currency. And what makes the mechanism so critical to the source's critique is that it is typically deducted automatically or withheld at the source by the transfer provider before the principal amount even leaves the U.S. system.
It acts like a hidden tariff, really. Let's make that calculation specific. If you are sending $2,000 to a family member in Jalisco, Mexico, you might previously have paid the transfer company, say, $50 in fees. That was your total cost, 2.5%. Now, the U.S. Treasury takes an additional $20. That's 1% of the $2,000. So your total transaction cost for that transfer just went up from $50 to $70. That's a $20 increase, which actually translates to a 40% hike in the cost of the transfer, cleverly disguised as just 1% of the total money moved.
And when you look at that on a single transaction, 10 or 20 bucks, it is indeed easy to just dismiss it or absorb it. But our sources immediately quantified the true scale, and this is where the policy becomes impossible to ignore. This 1% tax is projected to extract approximately $8 billion from working families in the first year alone. That is not a rounding error. That is significant capital being diverted away from international use and into the federal budget.
It's an absolutely massive extraction. It just underscores the sheer volume of these transfers. We are talking about a tax that directly affects 67 million individual remittance transactions annually. Just imagine that logistical volume, and this impacts an estimated 10 million American households, many of whom are sending money abroad every single month, sometimes multiple times a year.
The scale is astronomical. But the human cost embedded in that $8 billion is the most sobering detail. Our source material explicitly states that this is money intended for the most vital necessities abroad. I mean, this isn't money being spent on luxury goods or speculative investments. This is capital earmarked for feeding families, purchasing necessary medicine and healthcare for the elderly, and funding education in places where $100 genuinely can be the difference between survival and desperation. The government is literally taxing necessity.
And we have to emphasize that the legislation was crafted with extreme breadth. It makes it far more than just a tax on family support. The 1% tax applies to all remittances and transfers, and this fundamentally changes the landscape of international commerce for regular people and for small businesses. This is really where the critique starts to pivot from being a social issue to a critical economic signal.
Okay, so give us the examples of this crucial scope expansion. If it's not just the person sending cash to their grandmother, where else does this 1% friction appear?
It appears virtually everywhere dollars flow out. It applies if you're a U.S. resident transferring money from your domestic account to your own foreign bank account. Maybe you have savings or property abroad. If you're a U.S. resident paying an international contractor, say a specialist web developer in Bucharest or a copywriter in London who works remotely, that professional payment transfer is now taxed.
Wow, that drastically changes the character of this measure. The sources point out that even small to medium-sized businesses, SMEs, importing specialty goods and paying their foreign supplier or manufacturer are hit by this.
Exactly. The small business importing high-end textiles or specialized parts now faces a marginal increase in cost 1%, which they may or may not be able to successfully pass on to the consumer. This creates brand new friction in global supply chains at a time when the U.S. is already struggling with inflation and trade stability. And furthermore, you have to consider the foreign freelancer. If you are a non-U.S. resident receiving payment from a U.S. client, the client's transfer to you is what gets taxed. The financial friction is placed squarely on the outflow of dollars, regardless of the ultimate recipient or the reason for the transfer. The sheer breadth of the application signals that this policy is about control over currency movement, not just tracing or targeting family support.
The moment the government decides to tax a business payment to a foreign supplier, the same way it taxes a family remittance, the policy really shows its true colors. It's an attempt to slow the physical movement of the US dollar outside the nation's borders. So if the scope is this wide, and the impact is this profound for small businesses and working families, why on earth did the government push this through? Let's turn to the official narrative. The source material outlines the stated justifications when Congress passed the One Big Beautiful Bill Act, and these points were used extensively in the media to sell the tax. There are three main selling points, right?
That's right. The first justification was national security. The claim that taxing remittances creates a necessary disincentive against funding illegal activities, or at least provides more traceability. The second was pure revenue generation, collecting that projected $8 billion annually to fund essential government priorities, or, slightly offset the ever-growing deficit. And the third was framed as economic patriotism, the theory that taxing outflows encourages spending domestically and strengthens the U.S. economy by keeping capital home.
We really need to analyze each one of these justifications rigorously, because the source critiques suggest they are misleading, at best, and at worst, actively counterproductive to their stated goals. Let's start with national security. If money is being used for illicit purposes, shouldn't we impose friction? I mean, isn't some friction better than none?
That's a fair challenge. But the critical flaw, as pointed out by experts cited in our sources, is one of basic logistics. Criminals do not, and have not, used regulated bank wires or services like Western Union for large-scale clandestine transfers for decades. The reporting requirements, the KYC rules, the anti-money laundering mechanisms already in place, all of that makes those systems totally unsuitable for illicit activity.
So where do the illicit flows go then?
They go to unregulated, untraceable methods. We're talking sophisticated, trade-based money laundering schemes, cash couriers operating below declaration limits, or increasingly decentralized peer-to-peer cryptocurrency transfers, which often require no central intermediary. The U.S. government already has vast regulatory mechanisms to combat these methods. Imposing a 1% tax on formal, traceable channels is entirely redundant for national security purposes.
So you're saying the 1% tax on legal remittances doesn't even touch the criminals or the money they're moving?
Precisely. What it does is penalize the 99.9% of legal remittances being sent by nurses, landscapers, domestic workers, and small contractors. People who are using transparent, regulated services because they are honest and law-abiding. The source bluntly calls this a tax on honesty. The criminals don't comply, so the tax generates friction and cost only for those who are operating within the system. It's a mechanism that only traps the compliant.
That brings us to justification number 2, revenue generation. $8 billion annually sounds appealing, but we have to ask the source's profound question. Who is paying?
This is where the highly regressive nature of the tax becomes undeniable. This tax targets working families who lack the sophisticated accountants and offshore tax avoidance structures available to corporations or billionaires. The people generating this $8 billion are not moving millions. The vast majority are moving hundreds. The median remittance is consistently reported between $200 and $300 per transaction. Senders are often dedicating a significant non-negotiable portion of their paycheck, 10, 15, sometimes 20% of their monthly income, to these necessary transfers.
Let's use the source's specific example to make this concrete and to understand the real financial pain point. A household earning $40,000 annually and sending $500 a month abroad is sending $6,000 over the course of a year. The 1% tax costs them $60 annually.
$60 might sound insignificant to someone earning six figures, but for a family operating on a $40,000 budget, $60 is a significant and painful shock. Our sources detail exactly what that money represents for low-income households. That money is equivalent to a week's worth of fresh groceries, 2 full tanks of gas for commuting to work, or the cost of a necessary copay for a routine doctor's visit or prescription. To extract that from the tightest budgets is inherently regressive and, frankly, disproportionately cruel.
And the sources drive home this potent idea of quadruple taxation. You pay income tax, Social Security, and Medicare on those earnings. You've already contributed fully to the federal and state coffers, and now you're taxed a 4th time just for the act of moving that money internationally.
It's a tax on movement, not on earnings or consumption within the U.S. This is why the legitimacy of the tax is so quickly eroded in the eyes of the payers. They feel they're being punished for their family obligations, for having worked hard and complied with all the other rules.
Okay, let's move to the final justification. Economic patriotism. The assumption is that taxing outflows encourages people to spend domestically, thereby strengthening the U.S. economy. This is the government saying, keep your dollars here where they belong.
This justification is arguably the most flawed because it fundamentally misdiagnoses the nature of the transaction. Remittances are fundamentally not discretionary spending. Senders are not choosing between buying a new 60-inch television in the U.S. or sending money to their family. They are sending money because they have a necessary life or death obligation. Parents need medicine, children need tuition, families need rent money to survive. It is necessary support for survival.
So taxing it doesn't redirect that money into the U.S. economy. It simply reduces the amount the recipient receives abroad or forces the sender to make a larger, more difficult sacrifice here. The money was never going to be spent on domestic consumption anyway.
Exactly. And the source highlights the severe, counterproductive feedback loop this creates. When families send less money, recipient countries suffer an immediate economic shock. These nations, like El Salvador, where remittances account for a staggering 24% of GDP, or Haiti, where they exceed 38% of GDP, they rely on these flows for macroeconomic stability. Increased suffering, poverty, and unemployment abroad inevitably lead to increased migration pressure toward the U.S.
So the tax, framed as a way to strengthen America and reduce outflows, ultimately destabilizes the very economies that keep their citizens from migrating. It worsens the very crisis the legislation claimed to address, potentially costing far more in future enforcement and social services than the $8 billion it collected. Here's where it gets really interesting. I mean, if the official justifications are, as our sources argue, flimsy or actively flawed, then we have to look past them for the real reason this tax was implemented. This requires zooming out and understanding the precarious role of the US dollar globally, which is really the heart of the source material's critique.
We have to start with the concept of exorbitant privilege. Since the 1944 Bretton Woods Agreement, and reinforced later, the US dollar has been the global reserve currency. This status means the world needs dollars for trade. Most commodities, most notably oil, are priced in dollars, and nations hold trillions of dollars in reserves as savings and economic ballast.
And the privilege part allows the U.S. to essentially run massive, sustained, multi-trillion-dollar trade and budget deficits. We import far more than we export because foreign nations have to accumulate dollars, usually in the form of U.S. Treasury debt, just to participate in global commerce. We effectively export mountains of IOUs, and the world accepts them, allowing the U.S. to live far beyond its means.
Precisely. The system is designed to recycle those dollars back into the U.S. financial system via the purchase of treasuries, keeping interest rates low and demand for the dollar high. But the source material is ringing the alarm because that system is visibly fraying. The dollar's dominance is slowly, methodically eroding, and the data is pretty stark.
Let's look at that data. The dollar's share of global reserves has fallen significantly. It stood at 72% in 2000. By 2024, it was down to 58%. That is a substantial 14-point drop in less than 2.5 decades. And the pace of diversification seems to be accelerating.
And we see concrete geopolitical actions driving this diversification. The sources note China and Russia increasingly settling bilateral trade in their local currencies, bypassing the dollar entirely. The BRICS economic bloc is actively discussing the feasibility of creating a common settlement currency to reduce reliance on the dollar infrastructure.
But perhaps the most symbolic shift, which the sources highlight as critical, relates to the petrodollar system.
Yeah.
For decades, the U.S. ensured that global oil trade was denominated in dollars. What happens when that changes?
Well, that changes the core structure of global demand for the dollar. After 2023, we saw reports that Saudi Arabia, a cornerstone of the petrodollar arrangement since 1974, began accepting the yuan for some oil sales. This is a massive structural crack. If major oil exporters no longer demand dollars for their product, fewer nations need to hold dollars in reserve. This weakens the entire recycling system.
This leads directly to the nightmare scenario that U.S. policymakers, regardless of their political stripe, are desperately trying to avoid.
The nightmare scenario is this. If the world needs fewer dollars, they will stop hoarding them. And worse, they will start divesting from the trillions of U.S. dollars and dollar-denominated assets, primarily U.S. treasuries they currently hold. This capital, this immense volume of currency held abroad in foreign central banks and corporate accounts, will inevitably flood back into the domestic U.S. economy.
And that increased supply of dollars chasing the same or a shrinking amount of domestic goods and services means massive sustained inflation, or hyperinflation.
Exactly. The value of the dollar plummets domestically because the money supply has exploded, inflation spikes dramatically, the cost of imports, everything from electronics to medicine surges, and the standard of living for every American declines sharply. It quickly erodes savings and fixed incomes. This slow, methodical erosion of reserve currency status is the underlying anxiety driving the government's entire response, regardless of what they call the tax.
So if you're the government watching this inevitable process unfold, and you cannot immediately shrink the $36 trillion national debt, you cannot fix the structural trade deficit, and you can't convince the world to love your currency again, what is the fastest, cheapest, and most politically expedient thing you can do?
You implement controls to try and slow the outflow. You attempt to create friction points to keep dollars inside U.S. borders and reduce the total amount of currency flowing out to foreign nations. You want to reduce the overall global supply that might eventually return home. The 1% remittance tax in this critical context becomes crystal clear. It is a soft capital control.
It is not a full ban, not a Greek-style bank holiday, but it's a new intentional friction point. A cost applied specifically to discourage dollars from leaving the country, even if those dollars belong to working families sending legitimate support.
It's the government admitting through this policy action that they are severely worried about their currency status, and they are willing to sacrifice the financial well-being of their working-class citizens to try and slow the dollar's flight. This small tax is an enormous, flashing signal of fundamental structural weakness and desperation at the federal level. If we connect this to the bigger picture, what does history tell us about governments, regardless of their scale or political structure, that try to trap capital? The source material provides compelling and frankly terrifying evidence that this policy choice is a consistent, failed playbook, leading not to stability, but to accelerated collapse.
The sources outline a consistent historical sequence. A government facing intense currency pressure implements controls, often disguised as taxes or mild restrictions at first. These controls fail to stop the wealthy, sophisticated actors who find immediate workarounds. Instead, the controls disproportionately trap the middle and working classes, destroying public and international trust in the system. This lack of trust accelerates the crisis, forcing the government to tighten the screws, ultimately leading to either collapse, massive economic contraction, or hyperinflation.
And we have 4 major case studies laid out in the analysis, representing diverse economies and time periods, all pointing to the same conclusion. Let's start with Argentina, a perennial cautionary tale that spanned decades.
Right. Case Study 1, Argentina, 1982-2001. By the 1980s and 90s, Argentina faced continuous crippling hyperinflation. The peso was losing value rapidly, and capital was fleeing the country in search of safety in the US dollar, often moved offshore illegally.
And the controls implemented were incremental but pervasive. They restricted foreign currency purchases, imposed high taxes on currency exchanges, and eventually required complex government approval for any large transfers. The government's stated goal was identical to the U.S. goal we're discussing now: stabilize the currency by trapping capital domestically.
And the outcome was utterly disastrous. The sophisticated actors and the wealthy simply used accountants, offshore bank relationships, and complex trade mechanisms to continue their capital flight. They were basically untouched by the friction. But the middle class, reliant on the formal banking system, was trapped, watching their savings just vaporize due to inflation that the government controls couldn't contain.
Crucially, the controls created a massive, visible divergence between the official exchange rate set by the government, which was a work of fiction, and the black market rate, known as the dollar blue, which reflected the peso's true collapsed value. The source material emphasizes that this divergence, the signal that the government's stated price for currency was fake, completely destroyed public confidence.
And the final result. By late 2001, after years of these controls, trust was completely annihilated. The government, in a final act of desperation, implemented the corralito, freezing bank accounts and preventing citizens from accessing their own savings. This led to mass riots, multiple presidential resignations in quick succession, and a default on $100 billion in debt. The controls didn't save the currency. They shattered confidence and accelerated the systemic collapse.
Let's look at case study 2, Greece, 2015. This is a much more recent and relevant example, occurring within the structure of a major economic bloc, the Eurozone. Greece faced a severe sovereign debt crisis, and billions of euros flowed out of Greek banks within days as citizens feared either a forced exit from the euro or a complete banking system collapse.
And the Greek government responded with sudden, highly visible, and draconian capital controls. This was a transition from soft friction to hard lockdown, mirroring the accelerated escalation sequence our sources predict for the US if this 1% tax fails.
They limited ATM withdrawals to a symbolic, meager 60 euros per day. They restricted international transfers to absolute emergencies, and the banks were closed for weeks. The psychological and human impact was immediate. We all saw the images lines of elderly citizens at ATMs, desperate to withdraw enough cash for food, medicine, and utilities.
And this measure failed to restore confidence. Instead, it just signaled panic and desperation to both Greeks and the global market. Businesses couldn't pay foreign suppliers for essential imports. The economy contracted sharply because commerce just ground to a halt. The controls accelerated the crisis by proving, beyond a doubt, that the government had lost control of the financial system. For the average person, it showed that even their small savings were at the mercy of political decree.
Case Study 3, China, 2015-2017. Now, this is a key comparison because China is a large, powerful, centrally controlled economy. Even they could not escape the economic gravity. They faced massive capital outflows. Over $1 trillion left the country in a short period due to fears of economic slowdown and currency devaluation.
China already had capital controls in place, but they tightened them significantly. They limited how much foreign currency individuals could buy annually, dropping the legal limit from $50,000 to much lower amounts, and they cracked down hard on businesses using fraudulent invoicing or fake transactions to move capital abroad.
While China, due to its authoritarian capacity for enforcement and huge foreign reserves, did manage to slow the outflow partially, the economic cost was staggering. They spent $1 trillion of their foreign reserves defending the yuan's exchange rate, effectively burning capital to maintain confidence. It created immense friction for legitimate mergers, acquisitions, and international business operations, slowing growth. And globally, it signaled profound structural weakness. It told the world that the Chinese government was deeply worried about the stability of the yuan, ultimately making their long-term currency position worse.
And that leaves case study 4, Venezuela, 2003 present. The extreme, ultimate example of failed capital controls, demonstrating the logical conclusion of the path the U.S. is now taking. Facing a complete collapse of its oil-dependent economy and mass capital flight, the government implemented comprehensive restrictions that still exist today.
The controls were total: mandatory government approval for all international transactions, tight restrictions on foreign exchange, and an official exchange rate that quickly became completely fictional. The central mechanism of failure here was the total destruction of the private import sector. Businesses could not access the dollars needed to buy essential imports, food, medicine, manufacturing inputs.
The outcome was just total destruction. The controls suffocated the economy, leading to widespread, brutal shortages of everything. The black market rate diverged so far that the bolivar became effectively worthless, leading to hyperinflation reaching catastrophic levels. The sources cite instances of inflation hitting 1,000,000%.
The human cost cannot be overstated. Millions of refugees fled the country, seeking basic necessities that were unavailable domestically because the government's policies had killed the ability to import. Venezuela proves that the attempt to trap money domestically doesn't trap wealth. It traps poverty, destroys commerce, and eliminates basic supplies.
So the pattern is consistent across all these diverse economies. Attempts to trap capital destroy the very trust needed to maintain a stable currency. The government acts out of weakness, and that action becomes a self-fulfilling prophecy, accelerating the system's decline. Our sources are clear. The U.S. 1% tax is step one on this exact proven path to failure. Okay, let's bring this back to the U.S. in 2026. If history holds, the U.S. is currently on step one, the 1% tax. Our sources trace a highly predictable four-stage escalation sequence over the next 5 to 10 years, which history suggests is an almost unavoidable path to greater control and eventually crisis.
The first predictable stage, which we are already observing, is compliance decline, 2026-2027. The government projected $8 billion in annual revenue from this tax, but as soon as the tax hit, rational economic actors, both families and small businesses, started finding workarounds, shifting their money into untaxed or informal channels. Formal remittance volumes will inevitably decline sharply as individuals shift to alternatives.
And when the government sees the revenue fall short of projections, say they only collect $3 to $5 billion, they'll be forced to acknowledge that compliance is low. So what is the immediate policy response to regain that revenue?
Increased enforcement and visibility. This means tightening regulations and lowering reporting thresholds. We would see tighter KYC, know your customer rules imposed on all money transmitters, and critically, on cryptocurrency exchanges. Furthermore, the government will likely drop the reporting requirement for all international transfers from the current $10,000 down to perhaps $3,000 or even lower. The goal is to make it harder to send money abroad without government visibility and compliance. But every new enforcement mechanism creates more friction, which pushes more law-abiding people into informal, unregulated channels. It's a vicious cycle.
If enforcement fails to close the revenue gap, stage 2 is tax increase, 2027-2028. This is a simple political fix.
Correct. The government's justification will be familiar. Necessary budget needs, deficit reduction, or maybe a new manufactured national security threat requiring greater funding. They'll raise the rate, perhaps to 2% or 3%. It'll be framed as a small, marginal adjustment, just another 1% to meet the budget shortfall.
But the compounding cost for working families becomes significant. The family sending $500 a month, who is paying $60 annually at 1%, is now paying $180 annually at 3%. That $120 difference is a major, impactful hit to a household already on tight margins. They're now paying taxes that are explicitly designed to slow the outflow of a global currency, subsidizing the government's debt management through their personal hardship.
And if that still doesn't stop the capital flight, or if the global economic picture deteriorates, stage 3 is expanded controls, 2028-2029. This is the moment the measure transforms from a tax into a full, explicit capital control. The government will introduce quantity restrictions limits on how much an individual can send abroad annually, perhaps capped at $5,000 or $10,000 per person.
And that's the historical pivot point. Once the U.S. implements quantity restrictions, capping the volume of capital flow, the comparison to the failed states becomes unavoidable globally. International investors see the same restrictive playbook that crippled Argentina and Greece.
Absolutely, and that immediately triggers stage 4, black market emergence, 2029-2030. Restrictions create instant, massive demand for unofficial, cheaper, and faster channels. A parallel economy develops with its own unofficial exchange rate, reflecting the dollar's true, lower value abroad, a value that is suppressed domestically by the official system. The existence of that black market accelerates currency flight by those with sophisticated means while trapping the poor.
We have to pause here to internalize the specific human cost, because this policy disproportionately affects the most vulnerable people in the U.S. and abroad. Our sources use the powerful, concrete example of Maria.
Maria is a home health aide in Los Angeles, making $42,000 annually. She sends a necessary $400 per month, totaling $4,800 a year, to her elderly mother in El Salvador. Under the 1% tax, Maria pays $48 annually to the U.S. government. When you add that to her existing transfer fees, her total cost for sending that necessary $4,800 is now $228, nearly 5% of the total amount.
And Maria has a zero-sum, agonizing choice. She must either absorb that $48 herself, which means she skips the dental appointment she needs, doesn't replace her worn-out work shoes, or she cuts into her already minimal savings. Or, and this is the ethical cruelty of the tax, she reduces the amount sent to her mother to compensate for the tax.
If Maria reduces the transfer amount to absorb the tax, her mother receives $192 less per year. For an elderly person dependent on that income for survival in El Salvador, $192 is not incidental. Our sources highlight that this human cost is the difference between essential medicine and skipping meals for 3 weeks, or paying for school supplies for a grandchild. This illustrates why the tax is so destructive. It forces a difficult, agonizing ethical calculation between two low-income households, one in the U.S. and one abroad, simply to fund structural U.S. weakness.
That story is just profoundly tragic, because the government has inserted itself into an agonizing personal calculation. It's forcing two members of the same family to subsidize a national debt crisis. And as we noted earlier, the secondary impact on recipient countries is profound. A decline in these flows, enforced by U.S. policy, immediately leads to higher unemployment, increased poverty, and business closures in those nations.
The irony simply cannot be overstated. A tax justified as economic patriotism is, in reality, a policy choice that increases economic desperation in neighboring countries, thereby increasing the flow migration pressure directly back toward the U.S. The tax is a deeply destabilizing policy choice that actively works against its stated security and economic goals.
Let's talk about the immediate reality on the ground, just 2 weeks into 2026, when this tax took effect. Our sources indicate that the early alarms are already sounding, proving the elasticity of demand and the failure of compliance.
They are. Formal remittance volumes, the traceable ones that the government is counting on for revenue, are already reported down by 12% compared to the same period the previous year, even after adjusting for normal seasonal fluctuation following the holiday rush. This immediate, significant decline shows that people are actively, rationally avoiding the traditional tax system by shifting volumes elsewhere.
And that avoidance isn't quiet or centralized. Anecdotal evidence suggests massive community confusion and frustration, leading directly to the organic development of resistance in informal education.
We're seeing online communities across Reddit, Facebook groups, and ethnic community forums formed specifically to share step-by-step guides on tax avoidance methods. They're sharing lists of crypto brokers, walking people through the mechanics of crypto transfers, and detailing strategies for cash movement. This swift, organized, grassroots resistance instantly erodes compliance and legitimacy of the tax. The government imposed friction, and the market immediately sought pathways of lower resistance, often through systems the government previously viewed with suspicion.
So let's look at those pathways. What are the immediate untaxed alternatives that law-abiding families are being forced into to avoid this tax on honesty? Alternative 1, cryptocurrency.
This is increasingly the most popular non-traditional route, especially with the global familiarity of stablecoins. The mechanism is simple, but it does require technical steps. The center must first establish a cryptocurrency wallet and complete KYC on a regulated exchange here, like Coinbase or Kraken. They then buy a dollar-pegged stablecoin, such as USDC or USDT. They send that peer-to-peer to a foreign wallet, which is fast and crosses borders instantly without banking intermediaries. The recipient then sells the stablecoin for local currency on an exchange in their country.
The cost model is critical here. It completely bypasses the 1% U.S. government tax. The total transaction cost exchange fees and small network fees is often only 1 to 2%. That is significantly cheaper than the combined tax, plus the existing 2 to 3% transfer fees in the traditional system, which could total 3 to 4%.
The advantage is clear financial savings and government invisibility. The downside, however, is the logistical complexity. It requires a baseline level of financial and technical literacy from the recipient, which may not be feasible for, say, an elderly mother in a rural area. There is also the severe risk of irreversibility. If you send the money to the wrong digital address, there is no customer service, no bank to call to retrieve it. And of course, the ever-present regulatory risk that the U.S. government will eventually attempt to apply the 1% tax to crypto purchases specifically intended for international transfer or lower reporting thresholds even further.
Alternative 2 is an ancient system that relies entirely on trust. Informal value transfer systems, most commonly known as Hawala, popular across the Middle East, South Asia, and Africa.
The Hawala mechanism is trust-based and brilliantly decentralized. A sender gives physical cash to broker A in the U.S. along with a unique code. Broker B, in the recipient country, pays the recipient the equivalent amount in local currency upon receiving the code. Critically, no actual money crosses the border for the specific transaction. The accounts between the brokers are settled later through complex trade, commodity movements, or other large balancing transactions.
The cost structure is the primary draw. It's incredibly low, often just 0.5% to 1%, and it's fast, often same-day availability. But the primary advantage from an avoidance perspective is that it is virtually invisible to government tracking because the money never officially crosses an international wire network.
However, the risks are substantial. Since it's entirely trust-based, if the broker disappears or if there is a dispute, you have zero legal recourse. Furthermore, while the vast majority of use is by law-abiding communities simply trying to save money, Hawala operates in a legal gray area and is viewed with deep suspicion by governments who associate it with money laundering and terrorism financing. Law-abiding citizens are now being forced by a 1% tax into a system the government actively tries to police.
And the final alternative, cash smuggling, leveraging the existing $10,000 declaration limit.
This is the simplest option, involving travelers carrying cash across borders in physical form. For the traveler already making the trip, the direct fee is zero, aside from the transfer fees they might pay on arrival to convert it. The risk is high. High risk of physical theft, loss, or seizure and prosecution if the $10,000 declaration limit is violated. It's not scalable for massive flows, but it remains highly effective for family delivery.
The ultimate synthesis here is profound. The government, by implementing this tax, is actively forcing law-abiding families who have already paid their income taxes, Social Security, and Medicare into riskier, less transparent, unregulated methods just to help their families survive.
It proves that the tax fails to achieve any of its stated goals. It doesn't generate the projected revenue because of compliance flight, it doesn't stop criminals because they were already outside the system, and it doesn't promote national security. It merely shifts legal, ethical activity into the shadow economy, accelerating the loss of trust in the formal system and thus the loss of legitimacy for the government imposing the friction.
This entire deep dive has been about taking a small, seemingly insignificant policy, a 1% tax, and revealing it to be an absolutely massive, critical economic signal. The question is, beyond the operational failure, what is the meaning of this tax in the global context?
The core meaning is that the $8 billion revenue target is secondary. It's window dressing. This tax is primarily a signal of U.S. government weakness and anxiety. It's a direct, desperate policy response to the crippling $36 trillion national debt and the accelerating erosion of the dollar's reserve currency status caused by geopolitical shifts. It says to the world, we are worried about dollars leaving, and we are desperate enough to tax our own poorest, most compliant citizens to create economic friction.
And we've seen this movie before. We looked at Argentina, Greece, China, and Venezuela. The U.S. is not special in this regard.
That is the crucial historical echo. The U.S. is now following the exact, predictable playbook that ended in crisis for all four of those states. Empires throughout history, from ancient Rome to Spain in the 16th century, to Britain in the post-war era and the Soviet Union, that try to use controls or tax outflow to trap capital always fail. They didn't collapse because of the controls, but the controls were the clear, visible symptom that accelerated their decline by destroying commercial and public confidence.
So what does this pattern recognition mean for you, for the listener, whether they send remittances or not? What is the knowledge they should apply based on seeing this historical pattern unfold in their own country?
First, for senders, recognize that the 1% tax is just step one. You must start learning the alternatives now, stablecoins, how Hawala operates in your specific community, while they are still accessible, cheaper, and relatively unregulated. Do not wait until the government raises the tax to 3% and imposes strict quantity limits, trapping you in the failing system. Preparation is your only defense against entrapment.
And for investors and businesses who may not care about remittances, but care deeply about the stability of the dollar.
Recognize this tax as the undeniable signal that the government is profoundly worried about capital outflows and is willing to implement controls. This should trigger immediate diversification out of purely dollar-denominated assets. Look toward physical assets, real estate, commodities, or establishing stable international accounts and non-dollar currency holdings to prepare for future, harder capital controls that history indicates are almost certainly coming.
The cost of the tax is not the 1% deducted from Maria's money.
No. The true immense cost is the permanent loss of trust and the acceleration of the currency crisis. When the system implements friction, it forces millions of law-abiding citizens to operate outside the rules, whether through volatile cryptocurrency or untraceable informal networks. And when the government loses compliance through millions of small individual decisions, it loses its power and its legitimacy. The power shifts to those who facilitate the workarounds.
The question is not if the dam of capital flight will eventually break, but when and how much damage will be done to the social contract and the economy before the U.S. learns the universal lesson from history and reverses a policy that is currently on track to destroy public trust and accelerate dollar decay. That's a fundamental crisis worth thinking about long after this deep dive ends.